Welcome to another video. As you can see, the account is sitting at $18,319. The TFSA account is our largest account, sitting at $14,707. Today I want to go over a couple holdings and discuss why I like them so much in my portfolio. There's a couple areas of the market that are more choppy than others. Energy is one of them in Canada. It makes a large portion of the TSX composite, and I want to compare that to some other consumer discretionary stocks, maybe like Elementation, Couche-Tard, and one other stock I'm going to be getting into later on in the video. If you want to check out my weekly and daily trades, you can check out Blossom. There'll be a link in the description, and you can get a free $5 when you sign up with that link. Let's go over to the Dividend Tracker to check out some of these companies I'm talking about. So in the Dividend Tracker, we can dissect our companies in our portfolio. And the first holding I'm going to go over is Elementation Couche-Tard, ATD, on the TSX. So this company is in convenience stores. They currently have a 0.88% dividend yield and a 15% payout ratio with a 5-year dividend growth of 19%, which is just astronomical. They've consecutively paid dividends 17 years in a row. And let's just take a look at the overall chart of Elementation Couche-Tard and see how they've been performing over the last couple decades. So Elementation Couche-Tard currently trades at $64, and over the last 25 or so years, they've actually been on a very left to right increasing trajectory and on a very predictable path. They've actually done very well in 2019, and since then have been growing like crazy. So this is a very predictable company historically, and I want to make sure that we can find companies like that in the market in other areas, right? Let's check out Enbridge in our portfolio, and then let's check out their all-time chart to see how that compares with Elementation Couche-Tard. Enbridge is in energy, so it's in a completely different area of the market. But if we compare the two and see how they look with each other. So just for some comparison, Enbridge has a 6.7% dividend yield, and they've actually, this is misleading, but they do have a very high payout ratio as of right now. They consecutively grow their dividend every year. In the last 5 years, it's been about 5% annually. They've been paying dividends for 29 years, so this is a predictable company when it comes to dividends, but their share price is a different story. Let's take a look at their share price over a longer span of time. So Enbridge is currently trading at $52, and like I said, just under a 7% yield. And in the last year or so, they've been pretty steady, pretty even. And if we zoom out all time, we've actually seen a similar trend where they are growing left to right for some period, and then they are actually in a very stagnant period for the last 8 or 10 years here. So what makes this company different from Elementation Couche-Tard is that they slow their share growth, and that could be because of a high dividend policy or different shares outstanding, different share buybacks, and maybe how the company is changed being run during this period. So I want to make it clear that I want a dividend growth portfolio, but also something that can maintain its capital value. And Enbridge is one that is it's on a fine line between share depreciation and dividend growth. There's a fine line between the two of them. Elementation Couche-Tard is one that actually does very well. It's a lower starting yield, but they grow their dividend very heavily, and they actually do have some share appreciation through stock buybacks and growing earnings over time. Now, one company I actually do want to go over that isn't included in my portfolio is Loblaws, which is L.to, and they are in grocery stores. They own No Frills, they own Shoppers Drug Mart, and that sort of thing. In the last while, they've been doing very well. Let's go check out them on the Dividend Tracker and see their metrics, and also look at their chart over their historical period. So Loblaws is currently trading at $118 as of right now. They have a 1.38% dividend yield, so a little bit higher than Elementation Couche-Tard's, but quite a bit lower than Enbridge's. They pay out 25% of their earnings as a dividend, and they grow their dividend about 10% per year. They've been paying dividends for 33 years, so even better than Enbridge as of right now. So as this company looks really solid, as they don't have to pay out so much money to investors as a dividend. They can retain earnings and reinvest that into the company. Let's take a look at their historical chart to see how they've actually been doing over the last few decades. So again, Loblaws is at $118 over the last year. They're actually up 18%. And I remember owning this company when it was trading at about $16, and I thought I wasn't quite sure about it during that period. So if we zoom out to the max chart, we can see that it's a fairly steady left to right increasing chart. There was some depreciation in 2007 and 8, likely due to the recession during that period. But since then, has actually seen some decent growth, seeing over 300%, which is awesome for a company that also pays and grows their dividend. So this is a company similar to Elementation, where it has a lower starting yield. They grow their dividend every year, and they actually have share appreciation, and that's somewhat dissimilar to Enbridge, where they are just trying to make their shares stay afloat and not focus on share appreciation that much, and rather than just the dividend they do hand out, which is 7%. These are some comparisons of the types of companies in the market that you can find that pay dividends, but have different policies when it comes to paying dividends and how they are looking to grow into the future. And this is Loblaws is a company I want to really enter a position in, but they do trade at a premium at 18.7 PE ratio. And when you can look at other tech companies in America, this is a fairly high premium for a grocery retailer. So yeah, that's the wrap for Loblaws and Elementation. These are the companies I want to be focusing on going forward for the rest of 2023. I do want to own solid companies that aren't really affected by depreciation or a high dividend eating into the earnings of the company, because as interest rates are a little bit higher, that'll eat into companies' earnings and operating costs. And that's something that I want to try to avoid when investing in some of these sectors. So thanks for stopping in to another video. If you want to check out the Dividend Tracker, there'll be a link in the description. And same with Blossom, you'll get $5 for free by signing up with my link. If you like this type of content, please like and subscribe so you can stay up to date for future updates. See you next time.